Hi all, it's Jeff. Just as I said, I'm going to take you through another paper I've written. I've written two more papers, so we've got number 3, so multiple choice 3. This one's multiple choice 4, and I've done number 5, so we'll get practicing on what it is that we need to do. I was just saying to Nikat this morning as well that once you've had your meeting with Charlotte, tomorrow, I think it's 10 till 11, I'll see you at 11:15, okay? So 11:15 till about 12:30ish, and going through any questions that you might have. I'll probably go through that paper 3 paper. I've done quite a lot of questions for Friday for us to be practicing, and then some people said they'd like to stay behind and go through it. So there's a couple of newish questions on this one. So again, just to practice. So we've got this Friday, and if need be, then we've obviously got the tutorial on Thursday. We've got tutorial next Thursday, but again, if I need to put another class on, then I will do. So this is where we're at. So practice, practice, practice. So it said this. So which items will be debited to the accounts of the purchase ledger control account? Okay. So one of the things that we've done in the past is we've done the sales ledger control account. This one is the purchase ledger control account. I went through it briefly in class the other day. So this the purchase ledger control account. Okay. Gives us the amount of money that we owe our suppliers. So for example, on the credit side, as a liability, so if I've got a balance carried down of £10,000, it means that I owe my suppliers £10,000. And one of the things that we said in class is what would increase the amount of money that we owe to our suppliers. And the answer to that was it would be credit purchases. With the sales ledger control account, it will be credit sales. So credit purchases, so more purchases would increase the amount of money that we owe. So if we owe £10,000 at the beginning of the month and we bought another, say, £3,000 of the goods, then obviously it would increase it. Yeah. The other thing is what reduces the amount of money that we owe our suppliers. And it's quite similar to what we did with the sales ledger control account. So on the opposite side, so what reduces the amount of money that we owe our suppliers. So one of them is when we pay them, obviously. So therefore, payments to suppliers would reduce the amount of money that we owe them. Okay? So payments, so that's from the bank. Okay? You've also got any discounts, so discounts that we received from our suppliers. So discounts received would reduce the amount of money that we owe them. And again, so if these are purchases, so if we had any purchase returns, again, that would also reduce the amount of money that we owe our suppliers. Okay? I think it's worthwhile just drawing this to remind you for the other one as well when it comes to the sales ledger control account, because we did this in class, but just as an overview. So again, when we did the sales ledger control account, which are our trade receivables or our debtors. So if we apply the same example, so we had a balance brought down at the beginning of the month of £10,000, that basically indicates the amount of money that our customers owe us, okay? So what our customers owe us. So again, so what would increase this amount would be credit sales. So if we sold more goods to our customers on credit, then it would increase the amount, as I said before. So if it's £10,000 that our customers owe us, and we sold them another £3,000 of the goods, then obviously they would owe us £3,000. And again, so when it comes to what reduces the amount of money that our customers owe us, we simply apply pretty much the same context as we've done up here. So again, so we said payments, okay? So this would be receipts. So this would be bank receipts from our suppliers, okay, from our customers. So that will be bank receipts, okay? You've had discounts received for purchase ledger control account or discounts allowed. So discounts allowed is what we give our customers as a discount to encourage them to either buy more or to ask them to pay sooner. Okay? And then also we've got, so that was purchase returns, wasn't it? So again, similar to that one, we've now got sales returns would reduce the amount of money that our customers owe us. Okay. A couple more so far as the sales ledger control account is concerned as well is to do with bad debts. So a bad debts would reduce the amount of money that our customers owe us because we're not going to get it back. So that would be a bad debt. And then finally, as I've said in class, we've got what we call the contra entry. I'll do this in a different colour. So the contra entry is, let's say for instance so this is a purchase ledger. So say we're the suppliers. So let's say that we sell £1,000 worth of goods to our customers. So £1,000 we sell to our customers. So we sell them £1,000 worth of stock. But they also supply us as well. So therefore, let's say for instance that they pay us or owe us £1,000. So therefore, they're also a supplier, but also a customer as well. So we supply them, but we also buy off them. So what we do is do what we call a contra entry. So again, a contra entry is just similarly that. So if I owe the customers £1,000, but the customers owe me £1,000, so rather than go through that transaction, we just put it in the account. So for the purchase ledger control account, for this one, so what reduces the amount of money that our customers owe us, it would be what we call a contra entry. Okay? And that would be SLCA. Same situation with the sales ledger control account. So what would reduce the amount of money that our customers owe us? Yeah, it would be contra. But this time with the purchase ledger control account. So all we do in that example that I just said is we'll put £1,000 there and £1,000 there. So it like cancels it out. And that's what we mean by that. Okay? So we'll go back to the question. So this one is about purchase ledger control account. And it said, so which items will be debited to the purchase ledger control account? So discounts allowed? No, discounts allowed is something that we give our customers. Discounts received is what we get from our suppliers. Okay, so that's not one. So let's go on here, just rub that out. So discounts allowed isn't. Payments to suppliers, does that go on the debit side? So payments to suppliers, yeah, see, where we've paid them. So that goes on the debit side. Any purchases that we've made? No, that's on the credit side. So no. But purchase returns, yeah? So purchase returns is there. So the answer to this question is number 1 and number 3. Which is? Is it there? It's not number 1, number 3, is it? Just checking. It's number 2 and number 4. So number 2 and number 4 is that one. Yeah? So they're the ones that be on the debit side. Okay? We've done this one to death for the next one, but I'll go through it again anyway. So this one says, which of the following items should be recorded on the debit side of the trial balance? So again, going through what we did last time, if you use that P, so purchases, expenses and assets, and then we've got PEAR, which is revenue or income, so revenue, PEARL, which are liabilities, and S, which is shareholders' capital. So these are the debits and these are the credits, okay? So again, so it says, which of the following items should be recorded on the debit side of the trial balance? So on this side, so what should be on the debit side? So bank overdraft? No, because a bank overdraft is a liability, okay? Purchases, yeah? So purchases is on the debit side, so that one's a tick. So purchases. Sales tax payable, so payable is where we still owe, so that will be a liability, so that one's not. And then we've got trade payables, again anything with a payable is that we owe, so it's a liability, so that one will be wrong. And sales returns is where it's coming back to us, so therefore we did sell it out to them but they've returned it back, so this bit over here, so these sales returns, so therefore it's come back in to our stock. So therefore that is also on the debit side of the trial balance. Okay? So that would be B and E. For the next one, which again we've done a few times, I've done some bigger numbers this time. So this is a business uses an inventory using first in, first out, and it said the following transactions took place. Okay, so again, as we always do. So in May, we've got opening inventory where we've got 650 units at £25 each. So we go 650 units times 25. I wrote this down before. Is 16,250. So 16,250 is the value of the stock that we've got in May. Okay. In June, it says we've purchased another 550 units at £28. So 550 units times 28 equals 15,400. So 15,400 more stock. Okay. So at the end of June, we've got 31,650 is the total amount of stock that we've got. Okay. So by the end of June, we've got 31,650. In July, we issue out some stock. So we sell 400 units. So remember, these two are coming in and this one is going out. Okay. So therefore, it's telling us that we sold 400 units at £40 each. As I said before, that's the selling price, not the cost price. And we want to know what the closing inventory is. Okay. So we've issued out 400 units. So therefore, 400 units multiplied the stock that came in first. So this stock came in first, and that stock came in second. So therefore, we use that figure as the unit price. So 400 times 25 equals £10,000. So the cost of the issue, or the stock going out, was £10,000. Okay. So all we do here is we had 31,500. Let's just bring that down. That's pain. That's telling me that I've got a tutorial at 9:30 for year 3s. Anyway, which I haven't, so if I just rub that bit out there. Okay, so let me show you. So therefore, we had 31,650, but we've issued out 10,000 units. Okay, so that reduces the amount of stock that we had. So therefore, our closing stock figure is 21,650. That's the figure that you need for the answer. Just to take it a step forward, so here we had, what do we have? We had 1,150 units that come in. And we sold 400, so they've gone out. Which means we've got, what have we got? So that'd be 750 units, so 1,000 from 400 is 600, so we've got 750 units left. Okay, so that is called first in, first out. When it comes to stock, we've done that one to death, so hopefully that'll be a banker for you when it comes to doing the exam. Obviously, with different numbers, context is the same. This is a bit of a daft question, but I didn't write this one, so I'll just explain it to you. This one is said the company sells goods at a markup of 25%. The following information was available at the year. It's not really a calculation, this one, but I'll explain what we mean by markup. It isn't particularly relevant to this question as such, but markup is where we're saying 25% on cost. So, for example, if our goods were £300,000 as these are, and we had 25% markup, we'd multiply it by 1.25 or 25% on top. So therefore, the answer will be 300,000 times 1.25 will be 375,000. That's if we had a 25% markup. Okay. Well, this question says, what is the value of the closing inventory of financial statements? And the problem with this question is it says, so we've got goods in the warehouse which cost us £300,000, yeah? But then it says goods sent on sale or return of £200,000. So that basically means that it's not really included in stock because it said it's been sent, we've actually sold it. The fact that it's sale or return means it's not within our stock figure anyway, yeah? So therefore, the answer to that question is simply the £300,000. They're trying to catch people out by putting the 25% markup in, but that's what we do when we have a 25% markup. But this one is, it says, so what's the value of closing inventory? Well, that stock has already been sent out, so we don't include it. So therefore, the answer to that question is 300,000. Okay? The next one is a new one for you. Okay? And again, this one is important. I've done a couple of questions for you. So I did say to you a couple of weeks ago that the sample papers that we do, some of them you'll see similar questions, but every question that's in the exam will be there. There might be a little trick one in there, but everything will be there. So when I go through them, they're really, really important, okay? And this one is what we call inventory turnover. So it's how quickly does the organisation turn over its stock, okay? So I'll give you an example. So if it's sandwiches, we really want to turn it over quickly because therefore we don't want it to go out of date, okay? But for things, if we're selling aeroplanes or selling white goods such as washing machines, we're not going to sell those as quick. So this measures how quickly the organisation turns over its stock. And the formula for this is calculated by the cost of sales. So what did it cost us? So the cost of sales, I've done another exam question with this on for you, over the average stock. Okay, and this basically tells us how much or how quickly or how many times we turn over our stock for a year. Okay, this is probably something like white goods or maybe even cars because it's not very much, is it? Yeah. So therefore what we do to do this calculation, this is what we call the cost of sales, and again we've done this before in class, become more relevant. So cost of sales is calculated by your opening stock plus your purchases minus your closing inventory equals your cost of sales, okay? So this is how much does it cost us for those sales. So in this question, the cost of sales is 176,250, okay? And the average stock is, so you go for your opening stock, which is 15,000, in fact I'll do it up here so I can see. So you can see it. So watch. So the average stock is your opening stock, which was 15,000, plus your closing stock, which is 18,750, and divide that by 2, and that gives you the average stock. I did it before somewhere. Boom, 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 boom. Nope, can't see it. I'll do the calculation to show you. So therefore, the average stock figure is 15,000. plus 18,750 equals 33,750. Divide that by 2 means that the average stock figure is 16,875. So therefore, we put the average stock figure in here, which is 16,875, and we divide one by the other. So therefore, 176,250 divided by 16875 equals 10.4 times. So that's 10.4 times, which isn't a great deal. So it's basically saying you're turning your stock over 10.4 times a year. So obviously that's not fruit and veg because it's not much, is it? You'd be turning that over loads of times a year. But it's more so probably something like maybe selling cars, about 10 cars a year. I think that's fair enough. Or aeroplanes, I don't know. And it doesn't matter. The point being is this is how you do the calculation and how you work out that answer. Okay? So question 6, he said, which of the following is an asset of the firm? So remember, assets are something that we own. Liabilities are something that we owe. Okay? So it says, which of the following is an asset? So an overdrawn balance in the firm's accounts, it's not an asset, is it? Because it's an overdraft. We're overdrawn. So that would be a liability. So it's not that one. Capital of the firm. So capital is what the owners put in. So that's a liability. So that's not an asset. Machinery owned by the firm. Yeah, so machinery that we own is an asset. The answer to that one is that one. Okay? So that one's correct. So machinery owned by the firm is that one. You see money owed. So that one says just go through it. So number 6, money owed by the firm to one of its suppliers, again, is a liability. So the answer to that one is the machinery that's owned. Okay, so again, this one caused a few problems, but again, I've got loads of these for you to do in practice. So this is looking at what profit we've made on disposal of a particular asset. Okay, so this one says that the company bought a machine on October the 1st for £75,000. The machine had an expected life of 8 years and an estimated residual value of £19,000. On the 31st of March in year 6, the machine was sold for £53,000. The company's year end is the 31st of December. I'll leave it at that for the moment. But we're going to work out what is the total depreciation that we need to charge per year, and then what is the value of the asset when we sell it. Okay, so how much is it depreciated by? And what we've said in the past is depreciation is the wearing out of an asset, and how we calculate the depreciation using the straight line method is we do the cost. Okay, so we do the cost, which is £75,000. So we're working out the depreciation charge now. So to work out what the depreciation charge is per year, so we go 75,000 minus 19,000. I should have the residual values basically saying at the end of the 8 years we can sell that £75,000 asset for £19,000. Okay, so what we do to work out the depreciation charge is we do 75,000 minus the residual value of 95,000, yeah, which gives us 56,000 equals 56,000, and we divide it by the years, so over 8 years. So 56,000 divided by 8. 56,000 divided by 8 gives us, I think it's 7,000, isn't it? So 56,000 divided by 8 is £7,000. So that means the depreciation charge every year is £7,000. That basically means that the value of the asset goes down by £7,000 every year. Okay, so for example, year 1, so £75,000 was the value of the asset. Yeah, so after year 1 it would reduce by £7,000. Means that we would record it in the accounts at 68,000. Yeah, that would be for year 1. In year 2, we would reduce it by another 7,000. So each year it's being reduced by £7,000. Okay, so this is what we call the depreciation charge that goes into the profit and loss account as an expense. Okay, so for this question, it tells us that the company's year end is the 31st of December, and it says it uses a straight line method of depreciation, and it says it charges a full year's depreciation in the year of purchase, but none in the year of sale. Okay, I'll say this again. This is the same type of question that you need to do in the exam. So if you've practiced it, you'll understand it. Okay, so bearing in mind, if I just draw my little lines, just so you can remember. So for our year end is the 31st of December. Okay, so that means the start of our year was the 1st of January. So this is our financial year. Okay, so each year we're charging £7,000 depreciation for the asset. It tells us in the question that the machine was bought on the 1st of October, so on the 1st of the 10th. Okay, and it was sold on the 31st of March in year 6. So the 31st of March in year 6. Okay, so it tells us in the question that we charge a full year's depreciation in the year of purchase, but none in the year of sale. So therefore that means we've only, instead of the 6 years, because we sold it in that 6th year, yeah, we don't charge depreciation for that final year. So what we do is we go just over the 5 years. So we do 5 years depreciation. So we go £7,000 depreciation times the 5 years means that the cumulative depreciation, the total amount of depreciation is £35,000. So that is the wear and tear of the asset that we bought for £75,000. So this is called accumulated depreciation. Yeah? So we bought it for 75,000. Over the 5 years, it's reduced by £35,000. In brackets means minus. Okay. So therefore, all we simply do. So if it cost us £75,000, yeah, and the total depreciation at the end of year 5 is 35,000, means that the value of the asset, carrying value as it's called, or the net book value, means the value of the asset at the end of year 5 was £40,000. Okay, so that's the actual net book value it's called. Okay, so it's valued at 40,000, and what do we sell it for? Tells us that we sold it for £53,000. Okay, so simply we sold it for £53,000. The value of the asset at that time was 40,000. So therefore, excuse me. So therefore, we've made a profit of £13,000. Okay. Good. Number 6. So number 7. This one is a credit customer has returned goods which was sold for £6,000 inclusive of VAT. Okay, so this is a sales returns. But I think as I did in the previous question, I'm going to show you what the original transaction was. Okay, so it said which was sold for £6,000 inclusive of VAT. So when I've said to you before, when it includes VAT, we just simply divide it by 6 to get the VAT amount. So let me show you. So therefore, what we've got is the total amount. So it's £6,000. Is the value of the goods returned? Yeah. If we divide that by 6, that gives us the VAT amount. So the VAT is £1,000, which therefore means the net amount was 5,000. So let me show you how this was recorded in the sales when they originally did it. So what they would have done, we'll forget about the customer account, we'll just do the control accounts. Okay, I'll just do a little one there. So what we originally would have done is we would have gone the sales ledger control account, VAT, and sales. So the original transaction, we would have recorded that sale of £6,000. That's the total amount of money that our customers owe us. Yeah. So we credit sales 5,000. We credit VAT for 1,000. So obviously the 5 plus the 1 is 6. So that's sort of like the double entry, if you like. That's the original transaction that would have taken place. But this is a sales return. So these goods have returned now. So let me show you what we do for the sales return. I'll use those same accounts. So look, the answer is this one, but I'll explain why. So this is a sales return now. So what we would do, so credit receivables is the same as the sales ledger control account. It's our receivables. Okay, so what we would do to basically, because we're not going to get this money back from our customer, is we would basically credit the sales ledger control account or trade credit receivables by £6,000. We would debit the VAT by £1,000, and we never ever debit the sales. We create another account and we call it sales returns because we want to know what our sales returns were throughout the year. So therefore we would then debit sales returns of 5,000. Okay, so therefore it's cancel that transaction that took place. Yeah, again, I've got a few of those for you to do. Practice, and any questions, come back to you. Might come back to me, say on Thursday and say, Jeff, I didn't understand that particular question. Then again, I'll do loads of them so you understand them. I've done another paper for you on Friday, so I'll give you this one to do, and I'll give you another one to do in exactly the same format. So it's just practice. Okay. Next one is a relatively new one for you as well. The rest of them you've done before. So it said North is registered for sales tax. So North, who is registered for sales tax, received an invoice from an advertising agency of £6,000 plus tax this time. Okay. He said the sales tax on the goods was 20%. What would the correct ledgers be? So this is so North, who is registered for sales tax, received an invoice from an advertising agency. So they are invoicing us. Okay. So they're invoicing us. So it's really a purchase, and it's a purchase on credit. So therefore, to do the calculation, we go 6,000. Yeah, and then the VAT on that times 20% is 1,200. And therefore, the total amount is 7,200. Okay? So how to record this? Because it said we recorded it, well, basically, it's what we owe them. We've not paid them yet. So we received an invoice, so that shows we've not paid them. So how would we record it is we would do this one. So we would debit the advertising expense, we would debit the VAT, and we would credit the payables. Okay? So these are the payables, because we owe 7,200. Yep, so 6,000 would be the advertising expense. That would be the VAT, and that would be the payables. Okay? Right, okay, so I'll come back to that again, probably no doubt. So this one said, so the debts, we've done this one before, so the debts which are repaid within a short period of year, so these are debts now, so these are liabilities. And again, as I said in the past, we've got non-current liabilities, which would be those long-term ones. The long-term liabilities would be things like mortgages and bank loans and things like that, whereas the short-term liabilities are known as current liabilities. So the answer to that one, that goes in the balance sheet, is current liability or short-term liabilities. Okay? Again, we've done this one before. So David's opening capital, so non-current assets. So again, we do the accounting equation, assets minus liabilities equals capital. So the assets, he's got non-current assets of 23,500. He's also got inventory of 15,000. And he's got a bank balance of 7,500. He's then got liabilities, so he's got a bank, so he's got a loan from his father of 12,000. He's also got a bank loan of £15,000 to pay for. I put an extra note on there, didn't I? Let me rub it off. Better? 23,500. So it's 23,500. Right. It also says a loan from his father of 12,000, and he's taken out a bank loan to pay for those non-current assets, and the bank loan is 15,000. So therefore, as a process of elimination, we should be able to work out what the capital figure is. So we've got I've done this before, but let me do the calculation. I didn't do them. So you got 23,500 plus 15,000. Plus 7,500 means we've got £46,000 worth of assets. So 12 and 15 is 27,000. So we've got, so that should be a line there. Oops. So again, using the equation, so minus, so 27,000 are liabilities. So therefore that will give us the capital figure. So 46,000 minus 27,000 equals 19,000. So the answer to that question is £19,000. Yeah, okay, good. So the next one is to do with cash and other resources. Again, we've done this before. So those assets, so let's go back to assets again, because this is about what are the assets in the short-term assets. So those assets can be turned into cash or used up within 1 year, okay? So again, assets are something that we own. So non-current assets are those things that we buy for the long term. such as motor vehicles, buildings, all of those computers, fixtures and fittings, blah, blah, blah. They're assets we buy for more than 1 year, so they're called non-current assets. Whereas this one is called the current assets, is this one, okay? Because cash, bank, inventory, receivables, all of those, they're all things that change over a 12-month period. So therefore, current assets are those assets that change within that particular year. So are used up within the year, if you like. Okay? So current assets. Next one is a sales ledger control account again with numerous errors. So again, for this one, so again we need to look at what the errors are. I'll draw the accounts for you so you can see. So this is a sales ledger control account, and some of those things are on the wrong side. So again, sales ledger control account, or credit receivables, or trade receivables, whatever you want to say. So we'll call them receivables so you don't get confused. Is it receivables? So he's calling it sales ledger control account, same thing. So receivables or sales ledger control account. So what this is saying, we've got a balance brought forward, this one's right. So balance brought forward of 20,575, okay? So that basically means that our customers owe us 20,575. Going back to what I said before, so anything that, our customers owe us 20,575. What would increase the amount of money that our customers owe us is when we sell things to them, wouldn't it? So that would be increase the amount of money, wouldn't it? Yeah? And what reduces the amount of money that our customers owe us is when they pay us, or any discounts that we give to them, or any of those things. So what we do is we look at, so that one there, I'll take them list by list, so that one's right, okay? But this one is payments received, that should be on that side, because that's payments received, that's money we've received from our customers. So payments is 18,065. Okay, so that should be on the other side. So we've done that one. Credit sales, that one's fine. So credit sales. So we were owed 20,575, but then we've sold them more goods to the value of 16,303. So that one's on the right side. Discounts allowed, I'll do the crosses. So discounts allowed, that one's not right. It should be on the other side. So discounts allowed should be 368. And the contrary to supply, that's right, because again, that's basically again where we've sold goods to our supplier and our supplier owes us. So we're just taking that off. So that one's on the correct side. So the contra's fine. 250. So we just need to work out now. So what is the balance carried forward? Okay. So again, as we've done before, and this becomes much more relevant in the main exam. So 20,575, look at the side with the greatest amount, plus 16,303 equals 36,878. Take it across without thinking, 36,878. So the balance carried down, I'll do a different pen. So the balance carried down, the figure that goes in here, so balance carried down, is the balancing figure. So what figure goes in there to make it balance? So minus 18,065 minus 368 minus 250 is 18,195. So 18,195. Okay. Just to give you a bit more knowledge. So let's say this was transactions for May, as an example. Okay. So say this is the 1st of May, and this was the end of May. So this would be the same 30th of May. So what we do is, I mean, the answer is that, but I'm just showing how it all works. So the balance carried down is 18,175, and then what we do on the 1st of June, we do balance brought down of 18,195. And obviously the answer is that one. I'm just showing you how it works. So what we're saying is at the beginning of the month, So at the beginning of the month, our customer owed us 20,575. We then sold them more goods to the value of 16,303, meaning that they owed us 36,878. Yeah, but they paid us. So they paid us 18,065. We gave them a discount of 368, and also the contra entry of 250. So they're the things that have reduced the amount of money that they owe us, meaning that we're still owed 18,195. And that's how that works. And then we'd start all over again for the next year. Let's go boom, 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 boom. So for the start of the next month, we'll then start all over again and then do sales for June, and then we'll do payments received in June, and then we do discounts in June, blah, blah. So it all just carries on and on and on. Okay? Good? This is a similar question, isn't it? So this is the sales ledger control account. So again, another similar question. So the sales ledger control account again. So we'll do the same thing. Sales ledger control account, or receivables, as we call them. So this story of this one is, so the sales ledger control account entries are so sales. So we've got credit sales. I'm going to do a balance. We don't need time, do we? Ignore me. So the sales. So these are credit sales. So therefore they go on this side. So we've got credit sales of 62,000. So 62,500. So that's what our customers owe us. But then we've received, so these are bank receipts. So we received 56,250 from our customers. Okay? Sales returns, we also know reduces it. So sales returns reduces the amount of money our customers owe us, which is 625. Bad debts, so we're not going to receive £750 from the customers. So that goes on, reduces the amount of money that customers owe us. Excuse me. And then we've got a return unpaid check. So that means where we'd sold goods to a customer, they've returned them because we've basically not received the money. So that goes back into here. So this would be sort of the return check, if you like. So sales returns. So that would be 875. And then we've got the contra entry with the purchase ledger again. So the contra will be 1,000. So therefore we need to work out what the balance of the sales ledger control account would be. So 62,500 plus 875 is 63,375. Take it across, 63,375. And the balance carried down, different colour. So the balance carried down is, so take them off, so minus 56,250, minus 625, minus 750, minus 1,000, means our balance carried down is 4,750. So that means that's what our customers owe us at the end of the month. So therefore the answer to that, the balance, is 4,750. Okay. Simpler ones as such. So we said which of the following is not an asset. So which one is not an asset? So building is an asset. Computer is also an asset. So it's a non-current asset, as is a motor vehicle. So therefore that one is the liability. So the answer to that one would be the loan to buy the equipment, because it's a loan, as the name suggests. Okay. When we did this in class last week, I just explained. So the principle stating that all expenses incurred while earning revenue should be identified when the revenue is earned, and reported in the period is known as the matching principle. Okay. So what we need to do, I think that question underneath it helps a little bit as well. So what we've got, again, as I said before, So the 1st of January to the 31st of December, we need to match our income and our expenditure within that year. So the example for the question 17 is along the lines of, so let's say for instance that our sales in November, so in November our sales were £10,000, yeah? But we didn't receive it, if I put an extra note in, but we didn't receive the money until say January. So we received the money in January. Okay, the accrual concept and the matching principle says that we need to match our income and expenditure, okay, or our sales and revenue. Let's start again. We need to match our expenses and our sales from the asset equation. So we need to match them within the year of when they occurred. So the sales happened in November. They didn't happen in January. So cash, or when we receive the money, isn't necessarily when the sales took place. So that's called, for number 16, where it says that all expenses incurred while earning revenues should be earned when the revenues are earned. So it's when they're earned, not when we receive them, okay? That's called the matching principle. So to match the earnings when they are earned, not when they're received. And that's a similar thing. So the accrual basis, again, it's not when it's collected, yeah? So it's not when it's collected, it's not here. It's there when the sales happened. So when we do cash flow, that's more important. So when we receive the cash. Yeah? So similar question. So the matching principle is matching our expenditure. Yeah? When it's earned, I suppose, and when it happened. When it incurred, as it says. So our expenses when they incurred. Yeah? And our revenues when they are earned. Yeah? Not when we receive them. That's called the matching principle. And that also is similar when it comes to the accrual concept. So matching them. Okay? Number 18, again done a few times, the core objective of accounting should be a banker for you. The core objective of accounting is provide users of financial information, so provide financial information to the users of that information. You should know depreciation by now, so depreciation is the wear and tear of your non-current assets against any profits. And then finally, again one we've done a few times, so purchase of a motor van. This time it said depreciation of all vehicles or 20% on cost. Full year's depreciation is charged in the year of purchase. What's the depreciation charge in year 2? I'll do what I did in the previous question. So year 1, we got the motor vehicle, which is £40,000. Okay. Purchase of new tyres isn't capital expenditure, so we don't include that. And year 3 is not relevant because we want to know for year 2. So we want to know what the depreciation charge is for year 2. Depreciation charge is the same as it was for year 1. Okay. So what you do is 40,000 times 20%. Gives you the depreciation charge. So that is 8,000. So the depreciation charge is 8,000. Out of interest, as I said in the previous video, so for year 1, you would debit depreciation. So for year 1, so you got depreciation. And you got what we call cumulative depreciation, which is adding up depreciation. So for year 1, it will be £8,000. So we debit depreciation in the depreciation account and we credit cumulative depreciation by 8,000. That's the double entry. That gets written off every year to the profit and loss account as an expense. And this gets carried down. So we go balance carried down. 8,000, which therefore at the start of the next month, start of the next year gives a balance carried down of 8,000. We then do the same again for year 2. So for year 2, it will be 8,000 again. And 8,000. So you've got £16,000 worth of cumulative depreciation, but the depreciation charge to the P&L is still £8,000. Okay, that's just a bit of extra information that you need. All you need to do is work out what the depreciation charge is on the cost, and it's 20% of the 4,000, which gives you £8,000. Okay, that's it. So again, on Thursday, I'm going to go through the other paper that I sent out to you on the video. So any questions you might have, and that's important for you to let me know anything in particular you want to go through on Friday, and I'll do loads and loads of questions. So some of them should be bankers. I have done another paper, so multiple choice 5. And that one we'll do on Friday. It's exactly the same as this one, but just with different numbers. That still means that you need to know that one that I sent out on video. I'm going to send this one out as a blank to you with a video recording, and then you have a go at it. And we're going to go through this again on Friday, and we're also going to go through the new one that I put together as well. That's it. Okay, so enjoy the rest of your day.